Running a modern business is like steering a ship through unpredictable seas. The tides constantly shift due to market changes, and every decision can alter your course. In this environment, management accounting becomes your navigation system, helping you chart a path through uncertainty. Imagine the wind as consumer behavior, constantly shifting, sometimes unpredictable. The compass that keeps you oriented. That's management accounting information, guiding leaders toward informed decisions. It's the executive's radar, tracking costs, forecasting profits, signaling danger zones, and highlighting performance gaps. Without it, leaders are flying blind. Management accountants are the navigators on this journey. They transform raw data into actionable insights, enabling organizations to anticipate challenges and seize opportunities. Let's clarify two foundational terms in managerial finance. Cost accounting is a holistic system, identifying, measuring, recording, analyzing, and communicating cost data to support decision-making at every level. Costing, on the other hand, is a narrower technique within this broader system. It focuses on calculating the cost of producing a unit or delivering a service, crucial for pricing and profitability. For example, a management accountant might analyze the cost structure of a new product launch, or compare the profitability of different service lines. Their insights help businesses avoid costly mistakes and allocate resources wisely. In summary, management accounting is the language of business strategy. It empowers leaders to steer their organizations with confidence, adapt to change, and achieve sustainable success. For cost data to be meaningful in business decisions, it must be built on sound principles: consistency, use of uniform methods over time, objectivity, free from personal bias or subjectivity, clarity, simple, understandable presentation. Costing is often considered a finance function, but in truth, it is the decision engine for the entire organization. Product pricing prevents pricing misjudgments by anchoring to cost realities. Profitability analysis illuminates which products or customers are really profitable. Resource allocation informs decisions on where to invest people, machinery, and money. Costing isn't one size fits all. It is a toolbox. Job costing, suitable for custom production like architecture. Process costing, ideal for mass production industries like chemicals. Activity-based costing allocates overheads based on activities, not just volume. The more accurate your costing method, the more strategic your pricing and profitability analysis. Marginal costing reveals the hidden profitability beneath fixed costs. Only variable costs are considered in decision-making. Contribution equals selling price minus variable cost. A factory with surplus capacity should accept an export order at Rs80, even if the total cost is Rs90, as long as the marginal cost is only Rs70. CVP analysis answers the most fundamental business question: how many units must I sell to break even or hit my profit goals? Break-even point: units at which total costs equal total revenue. Formula: break-even point equals fixed costs divided by selling price minus variable cost. Advanced applications include sales required for target profit and price impact analysis. In retail, this can help you visualize the impact of seasonal discounting or high-volume promotions. Don't just chase revenue, chase contribution per constraint. Maximizing product mix. Use contribution per limiting factor like labor hour or machine time. Operate as long as revenue exceeds variable cost. Standard costing, predetermined costs set as benchmarks to assess actual performance. Step-by-step define cost centers, classify costs into direct material, labor, and overhead. Set benchmarks for material quantity and price, labor hours and rate, overheads based on volume. Involve operations team in standard setting for better engagement and performance. Variance analysis. Analyze the gap between standard and actual costs. Material cost variance equals standard cost minus actual cost. Focus on controllable factors. Price variance equals standard price minus actual price times actual quantity. Usage variance equals standard quantity minus actual quantity times standard price. Real-world case study. Kanpur Auto Components Pvt. Limited product, precision gears. Selling price, Rs1000. Variable cost, Rs700. Annual fixed costs, Rs60 lakhs. CVP analysis. Break-even units equal 20,000. Actual sales, 30,000. Margin of safety, 10,000 units or 33.33%. Special order analysis, export offer. Price, Rs750. Contribution, Rs50 per unit. Order size, 5,000 units. Additional profit, Rs2, 5 lakhs. Decision, accept the order due to idle capacity. Variance analysis, Rs92,000 overrun. Price variance, Rs52,000 from procurement. Usage variance, Rs40,000 from operations. Integrated use leads to optimized operations. Cost accounting is not just a tool for bean counters, it is the very language of management. It informs pricing, signals inefficiencies, boosts performance, and strengthens strategy. Master it, and you master the pulse of your business. Chapter 9. Complete. Up next, budgetary control, building financial discipline into the DNA of your organization. Chapter 9. Review questions. Differentiate between cost accounting and costing with examples. What is the strategic value of cost volume profit analysis? Explain the contribution concept in marginal costing. How does standard costing support performance benchmarking? Continue your learning journey with Chapter 10.